Hello, I'm Mario Robleto with SAENICSA Accounting and Tax Services located in Managua, Nicaragua. And today, we will be covering the topic, what expenses do businesses pay? So stay tuned. The answer to this question may seem self-explanatory, but that's not entirely true. This is due to the fact that many people have difficulty interpreting an income statement. So today, we're going to break down what makes up this statement. And we will also mention an interesting metric that you can use for your business, Cogs, or cost of goods sold. If your business sells a product, you have to source and transform raw materials to create it. The costs that are related to sourcing the raw materials needed to make your product and the cost of transforming them into the finished product are grouped together and kept separate from the other expenses that your business pays. This grouping of costs is known as Cogs, or cost of goods sold. On the financial statement, you'll see something like this. It is important to know what your costs are to produce the products you sell, because this represents the gross profit, and this indicates the profit you have only considering what it costs to make your product. Therefore, it is important to pay special attention to this information, because if the gross profit margin becomes too small, then there will not be sufficient funds to pay for the administrative and operational expenses of your business. In other words, you'll quickly go out of business. Operational expenses. Once we have our gross profit, the next section of the income statement is for grouping operational expenses. Operational expenses are the expenses that businesses need to pay in order to keep their doors open and get products into the hands of their clients. So under operational expenses, we have salaries, rent, electricity, accounting fees, legal fees, postage, fuel, and so on. Now, when we subtract from gross profit our operational expenses, well, that'll give us our net profit before tax. Now, there is an interesting exercise that you can do with your income statement that's very beneficial. I'm referring to calculating EBITDA. What is EBITDA? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. EBITDA. Now, assuming that interest, depreciation, and amortization weren't already included in your COGS or operational expenses, our net profit will be synonymous with EBITDA. But if not, then these line items would need to be added to the net profit so as to equal EBITDA. What is EBITDA useful for? Doing an exercise like this with your financial statements is useful when trying to compare the productivity and operational margin of a company, because EBITDA tells us in simplest terms how profitable a company is at making and selling their products without any additional consideration to tax liabilities, financing costs, depreciable assets, and so on. It isn't that those points aren't important, but at the minimum, it provides another yardstick for measuring a business's profitability. Well, that has been our video for today. We hope that you've enjoyed it and that the tips we've discussed, you'll be able to implement them in your business. Thank you for watching. Until next time, stay safe and take care.